Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, Eitel.
All right, you heard the man. My name is Mark Eitel, host of the Mr. Mortgage Show, and we do this every week at the same time right here on this same station. So thank you so much for joining us. You, my friends, are in the right place this week if you want to walk away from this episode with the information that you need to make better mortgage and real estate decisions for you and your family. There is a lot going on. We're going to dig into it. I'm getting a ton of questions during the week. What the heck are going on? I'm getting a ton of questions. What in the heck is going on with real estate? I mean, one more time, Tom. I'm getting a ton of questions. What in the heck is going on with mortgage interest rates? Are these rate hikes going to burst the bubble? Are we in a bubble? What is happening? Are we seeing demand slow? We're going to dig into all of that. I know there's a lot of concerns surrounding all of those topics. So I've taken a bunch of questions from the week, and I'm going to weave them into some answers during the show, as well as take all of your questions. So to get your questions to us, the Anytime hotline is 561-291-8569. That's 561-291-8569. As always, you can call or text those questions to that hotline number. Dom, my producer, is here. He's running the board as well as the hotline, so he'll be the guy that answers the phone and gets you on the air or get your question to me. So, and if you're not comfortable calling in, just shoot a text to that number, 561-291-8569. And I just want to throw this out. We built a new Facebook page for the show, and we're using that to host all of the articles and the data sets that we use, that we talk about on this show, so you can read the articles yourself, dig deeper, and see where we're getting this information and kind of get into the mind of Mr. Mortgage, if you will, and get an understanding for yourself, what's going on. But as always, we are happy to take your questions directly on the air. 561-291-8569. Again, I'm Mark Eitel, host of the Mr. Mortgage Show. So happy to be with you. So not a lot of earth-shattering news this week. I mean, the Fed came out on, I believe it was Tuesday or Wednesday, and basically said, guys, hold on. Inflation's out of control, and we are, determined to quell inflation. And the only way they can do that is raise rates. They've insinuated the next rate hike is 50 basis points. This is nothing new if you're a listener of the show or you follow us on social media. We've been talking about this for a long time. We've got some great strategies that we'll cover in this show to kind of work you through all that. But hey, inflation is here, and we need to kind of put out that fire. It's kind of startling, though, when you listen to these guys who are telling you, and I'm talking about the Treasury Secretary and the Fed and the whole team up there. They're telling you, it's out of control. Don't worry, we've got this. They're the same people that told us, hey, don't worry, inflation is transitory. So it's just kind of ironic that it's always after the fact, right? It's like cleaning up after the storm. But anyway, the reality is, even where rates are, they're super, super low. So I just want to throw this statistic out, and I'm not going to bore you with a bunch of stats, but the lowest 30-year fixed rate ever recorded by Freddie Mac in their report, that I'll actually put this in the Facebook page, was 2.68%, and that was in December of 2020. So when you're talking about a rate in the fives and your only perspective is 2.68 from the all-time low in December of 2020, of course, 5.5 looks like a big rate. But to put this in further perspective, the highest ever recorded was 18.63% in 1981. So looking at 5% from there, this looks like free money. So just keep everything in perspective. The sky is certainly not falling. We're gonna cover a lot of the data around this to kind of support some different opinions. So anyway, let's dive right into your questions. I know we've got a couple that already came in, and then I'll get to the ones that I brought with me. But let me throw it over to Dom and see what we have for questions.
All right, Chris shot us a text. Chris is asking, are you still doing the free appraisals? I used to hear you talk about that. How can I get one?
Hey, Chris, that's a great question. So I think what you're alluding to is the free value report that we used to, and I don't know if we still advertise that or not, but yes, I'm happy to do that for you. It's not an appraisal. It's just, it's a desktop evaluation tool that we as lenders use to get a quick value determination on a property. It's pretty close to the appraised values. I mean, it runs really close, but I don't want to mislead you. It's not an appraisal. It's about a 10 or 15 page report. It's a pretty interesting report. I'm happy to do it for you for free. Hit the website freevaluereport.org. That's O-R-G, not .com, freevaluereport.org. Just type in your property address and give us your email, and we'll shoot you back that report. But happy to do that for you. Hey, Dom, do we have any other questions?
We do. Rhonda left us this on the hotline. Rhonda's asking, I read the headlines. Rates are way up. Big mortgage companies are firing people, and home prices are still going up. Aren't these signs we're in a bubble?
Well, yeah, so that's a great question. And it kind of alludes to what I was talking about. Actually, there's a video on the Facebook page that I posted last week that talks right to this. So you're right. All of that, it sounds super scary. And if you're defining a bubble by a rapid appreciation cycle, then yes, we're in a bubble. If you're defining a bubble by something that's going to burst, I'm of the personal belief that the bubble is not going to burst. I think what's going to happen is appreciation is going to flatten and allow it to catch up to itself. So we've seen, 10 years worth of appreciation in 2 years. So there's two logical solutions to that, if you will, just from a pure, I don't know what the term I'm looking for. My hands are waving around in the air as I'm stumbling around for a term, but I guess ways for it to self-correct, right? The bubble bursts and it comes back to where it's supposed to be. So we erase 8 years worth of appreciation that we had, I just mentioned 10 years in 2, or we go into a flattening appreciation cycle for the next 8 years and allow it to catch up. My personal belief is that's what's going to happen. And I don't know that 8 years is the number. I'm just using round numbers for conversation's sake. But I believe that we're going to go into a slowing appreciation cycle, and home prices are going to ease in some areas, not all, for a whole litany of reasons. And that video that I mentioned on the Facebook page goes into it in great deal. But a lot of it has to do with what got us here this time versus what got us here in the early 2000s. And some of you know, some of you don't. I started in the mortgage business in 1999, grew up in a family of home builders. So I've been in real estate my entire life, and I'm an old man now, so I've seen some things. The cycle that we were in the early 2000s was very different. It was fueled by artificial demand. And by artificial, I mean one person was buying multiple properties with interest-only adjustable rate mortgages. So they were using very risky mortgage products to buy a bunch of properties. They owned several. When those rates started to adjust and they could no longer afford those payments, they then were forced to sell. Now, that worked in the beginning when properties continued to appreciate. They were selling as soon as the prepayment penalty expired. They never were suffering from that adjustable rate. Great. That worked for 3 or 4 years as we moved into that cycle. Now, later in that bubble cycle, at the same time, all of those adjustable rate mortgages came due. That one individual didn't put one for sale sign in the yard. He had multiple for sale signs in the yard. So a flood of inventory at the very same time that the secondary mortgage market liquidity in the subprime, those dangerous loans, dried up. So there's no more easy money. Now, even if easy money didn't go away, I think we still would have had a problem because he was trying to sell 10 properties. It would have taken one guy, or 8 properties, whatever it was. It would have taken one guy who wanted 8 properties to make that an even transaction, demand to supply, even it out. So this time around, and I'm going to close with this time around, we have fully underwritten fixed rate mortgage products that are being used to buy properties. So people are either getting a fixed rate, 10, 15, 30-year fixed rate, fully underwritten, no stated income, no stated asset. We're looking at everything, and or paying cash. So there's no payment shock in the future that's going to force them to have to sell. Couple that with they're buying their primary home. So they're not going to lose that home if they can avoid it. They're going to lose the car, the boat, everything else, but they're going to keep the home. So, hey, check out the Facebook page. There's a long not long, it's about 15 minutes, 12 minutes. It explains all of this in length. But you hear the siren behind me. That means Dom is chasing me out of the seat into a break. We'll be right back in 2 minutes to take your questions. Give us a call at 561-291-8569. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. I host the Mr. Mortgage Show every week right here, same station, same time. So thank you for joining us. I know I kind of rushed out of that explanation, and I did promise everybody that I was going to cover some of the questions that have come in during the week. So that's one of the big ones, and I just want to kind of summarize that because I get very passionate about this. But in the bubble bursting phase, we saw, single individuals with multiple properties with interest-only adjustable rate mortgages, and their strategy was to put a tenant in that property and cover the mortgage expense, which was interest-only at a low introductory rate until it adjusted or the prepayment penalty expired, and then they could sell it. So these people were racing out buying multiple properties. And we saw people with, 8, 9, and average people, regular working people who used stated income, stated asset loans to buy these properties. And when those payments adjusted, there was no one left to hand the hot potato to. No one wanted to buy 10 houses from this guy. That started the inventory glut, which was magnified by the fact that the secondary mortgage market dried up for subprime loans, and supply and demand is what controlled that market, not cost of money. So there was a ton of supply with very little demand, and the prices went down, and then it just spiraled from there with the foreclosures. This time around, we're seeing single families buying their primary home. This demand it may have been fueled by COVID and the artificially low interest rates, but it was genuine demand for housing. They weren't trying to flip it. They were looking for a primary residence, and most people were seeing maybe a second home, maybe one or two investment properties that are legitimate investment properties, right? They're rentals, they're fourplexes, they're duplexes, they're legitimately an investment property. So very different landscape. And then lastly, I'll close with this. They're using fixed rate mortgages and cash to buy these homes. So there's not a payment shock in the future that's going to force them to have to sell. And again, I'm going to reference the videos on the Facebook page. There's one about bamboo toilet paper, which which is talking about supply and demand. And the other is the one I just mentioned, where we're talking about 6% interest rates are not going to burst this bubble. So hopefully that helps. I'm not going to touch on that anymore unless there's additional questions, because I want to keep this party rolling and get to your questions. So I'm going to throw it back to Dom and see what he has teed up. What do we have, Dom?
All right. Danny emailed this one. Danny's asking, what are the pros and cons of using the Builder's Mortgage Company? I feel like the sales agent is pushing us in that direction.
All right. That is a great question. We hear that often. And yes, they are pushing you to use the Builder's in-house lender. And there's a couple reasons they're doing that. One is, honestly, they want control of the deal. They want to know that you're going to close. They don't want to trust a third party's approval. They want to know. That's how all this started, was the builder wanted the certainty that they had the most qualified buyers. So it started with the intent of, innocently enough, they wanted the full peek behind the curtain. They didn't want to have to depend on your bank or an outside mortgage company to know this was a good deal. But don't kid yourself, it's a profit center for the builder. It's part of their business model. They have in-house title services. They have in-house mortgage companies. So I don't know how many of you are old enough to remember. I think it was CarMax used to have the TV commercial, and the guy had the long, skinny balloon in his hand, and it's the same kind of balloon that they would make, little balloon animals out of. And he would squeeze one end and say, okay, a typical dealer will lower the price. And he squeezed that end of the balloon, and the other side of the balloon got really fat. He said, but if you squeeze price, then the interest rate on the loan goes up. Or if you squeeze down on the interest rate side, the price goes up. And he was using that to symbolize that CarMax played no games. Just know that, when the builder comes out and says, hey, we're going to give you $20,000 in upgrades if you use our team. Well, first of all, they're not dollar for dollar giving you 20 grand worth of anything, because if it cost them $5,000 to upgrade the kitchen or to put the cool tile in or the wood floors, whatever you want, they probably have $5,000 and it didn't cost them 20. The sad part is you can't go out there and upgrade your kitchen for $5,000 without it. So I understand the enticement. So to answer your question, the pros are you can usually get some closing cost credits, some upgrade credits, whatever the case may be. The cons are that that's the builder's lender. And I'm going to share a story with you, and I'm not going to mention any names because I do not have enough money in my war chest to defend myself against a lawsuit from a national builder, but this just happened to us, our team. We just experienced this last week. We had a builder, in-house mortgage company that denied a transaction 5 days before it was supposed to close. They apologized. The builder offered to give the client their deposit back. Now, they waited 18 months to buy this home. 18 months they've been renting a place on a month-to-month because they didn't know when they were going to close. They didn't want to sign a lease, so they're paying an elevated rent month-to-month for 18 months. They picked out the flooring, the paint colors, the perfect kitchen cabinets. They had a wall moved. This is their dream house. 18 months later, they find out that the in-house mortgage broker says, we can't fund your deal. You're denied. So the builder was gracious enough to give back the deposit, and they resold the house for $125,000 more because it's appreciated over the last 18 months. So in those 5 days that they had this news, the realtor, who we have an amazing relationship with, brought the deal to us, and we tried to salvage it. Here's the thing. We got them approved. We got them approved with a conventional rate. It was no Mickey Mouse stuff. It was a great mortgage program. There were no problems with the deal. There were some sticking points that our team with over 30 years experience were able to navigate around, but it shouldn't have been denied. But here's the thing. We asked the builder for an extension because we need a new appraisal. They would not transfer the appraisal to us. So 5 days wasn't realistic. We needed about, I don't know, I'm going to say 8 or 9, but we were asking for a 15-day extension. So the buyer and the buyer's agent walked away from that feeling manipulated by the builder. Did the builder have the client's, or the builder's mortgage company rather, have the client's best interest in mind when denying that file? Or did they have the builder's best interest in mind when they denied the file and in turn resold the property for, I don't know, what did I say, $120,000, $150,000? I'll have to look at the numbers more because it appreciated. So yes, it makes sense because you often can get closing cost credits. You can get upgrade credits. It's super enticing. And, 9 out of 10 times it works really, really well. And I can't tell you how many times in my career I've just bowed out to the builder's mortgage guy and told my client, listen, go with them, get the kitchen upgrade, get all the great stuff. Let me review the rate pack in mortgage package that after you close. And if we can better it, we'll refinance you. If we can't, you got a great deal. We'll work with you through the process and just kind of stand by your side. We've bowed out of that because, a $20,000 kitchen upgrade is enticing. But for that 1 out of 10 scenario, as I just mentioned, that person would have been well suited to have their own mortgage team in place from the very beginning. So just keep that in mind. I mean, if you were getting divorced, would you use your wife's divorce attorney? And I'm not saying that, a builder-client relationship is adversarial like a divorce. I'm just saying having your own team who's watching your own backside is super important in some major decisions. At very, very least, get a second opinion on the mortgage and maybe get an approval. We'll do it for you. I'm happy to help. We'll give you an approval and take it back to the builder and see if they can match it. If they can match it, fantastic. Then you've got a great deal. If they won't match it, then go with your own. Go with us. I'm happy to do it. As a matter of fact, now that I say that out loud, that sounds like an awesome strategy. If you're considering using the in-house mortgage team, go with the Mr. Mortgage team. No, with anybody. We'd love it to be us, but with anybody that you have confidence in, get your own pre-approval, take it to the in-house company and see if they'll match it, and then see if they'll give you an extended rate lock or a rate lock guarantee, because that's the other side of the coin, is what happens when the rate lock expires and you have to buy an extension. And if it was the builder's fault and not your fault as the client, who's paying for that extension? So if you have questions around that, give us a shout, 561-291-8569. That's 561-291-8569. At very least, I'll give you some great questions to ask the builder's lender, so you'll know you're getting a great deal. So anyway, I hear that siren. Maybe that's the builder's lender coming up behind me with a big stick. But no, give us a call. I'll walk you through and answer any questions you have. So 561-291-8569 is the Anytime hotline. 561-291-8569, or as always, www.mr.mortgage. That's mr.mortgage, never ever a .com. Mr.mortgage. Thanks. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back, and I just looked out the window of the studio and I see a parade of builders, mortgage companies with burning torches marching around the building waiting for me. Guys, I wasn't talking badly about you, I swear. No, anyway, I hope that answered that question. You certainly should have at very least a second opinion so you know you're getting a great deal. Make sure that upgrade package is really, really worth it. So anyway, I hope that helped. We try to do all this, give you the best information that we have to help you make better mortgage and real estate decisions. This is important for you guys. It certainly is the largest financial commitment that most of us ever make in our lives. And I was blessed at an early age to make mine with some very good advice from somebody who, they just kind of pushed me off the ledge and said, you're old enough, you're paying rent, you should be paying a mortgage. And it made a significant difference for me. So building equity, and it introduced me to this side of the business. So super excited to be here. But anyway, my name is Mark Eitel. This is the Mr. Mortgage Show, where we answer your mortgage and real estate questions and try to do it with a little twist of fun. So speaking of questions, I'm going to throw it to Dom and see what we have.
Brandy just called. Brandy asked, I have lots of equity and want to use some of it to buy a couple of investment properties. How do you recommend I do this?
Hey, Brandy. Before I answer that question, I have to ask you, does anyone sing that song back to you, that Brandy song from the 70s? I wanted so badly to sing that, but there's a reason I play the drums in my band and don't sing, because this is the only time I should be allowed to have a microphone. And there's several people that would argue that even now I don't deserve one. So anyway, Brandy, good question. There are a lot of opportunities in the market to own rental properties. Now, if you're going to buy flips, there's different strategies around that, and I'm happy to help. But I'm going to use your question to talk about some strategies that we're seeing people execute to buy rental properties, because as we all know, rent prices are going crazy. I mean, there's really no slowing in sight, and it seems to be supporting the housing prices because if you can rent or own and the price is about the same, you might as well own. So anyway, if you're buying rental properties, here's something to consider. To take the money out of the property, I'm assuming that you don't want to refinance your first mortgage. You may have gotten a great rate. And if that's not the case, then doing a cash out refi might be the answer. But let's talk to the people out there who are considering doing what you're doing, yet they've already refinanced in the last 2 years and they're sitting at that historic low rate that I mentioned in the opening segment of 2.68% for a 30-year fixed rate, which is crazy. If you got it, congratulations. That's amazing. So if you're one of those people with a ridiculously low rate, but you want to pull some of this equity out to capitalize on other opportunities, there's a couple of ways to do it. One is a home equity line of credit, a HELOC. A home equity line of credit is exactly as it sounds. It's a line of credit collateralized by the equity in your home. Here's the cool part about it is there's very rarely any costs associated with it. So you can get it for, relatively no upfront expenses. It's a low interest rate to start with. It's interest only, usually interest only, for a period of 10 years. And then if after 10 years, they take your balance and convert it to either a 10 or 20 year loan. So for 10 years, you have access to this credit line. Here's the downside with an equity line. And I'm speaking to anybody in the audience who's old enough to remember the crash, which wasn't that long ago. An equity line can be closed against your will or reduced against your will. So let's say you've got a $100,000 equity line that you never use. And let's say some of these fear-mongering headline writers are correct and we are going into a crash and values pull back. Well, if your value pulls back and you don't have enough equity to support that underwriting risk for that equity line, they may say, hey, Brandy, you're a fine girl. What a good wife you would be. See, I had to work that in there. But they may say, hey, Brandy, you have a $100,000 equity line, but that was based on a property value of $400,000. Now your property's worth $360,000. We're going to back that down to $60,000, whatever the case may be. So they have control over it. And if there's zero owed on it, they can close it out altogether. I can give you a list of, dozens and dozens of people I know that happened to in the early 2000s. The other way to access it, which is probably the easier way from the standpoint of pull the funds out, use them, and never have to look back, is a home equity loan. And that's usually a 15 or 20 year term. It's all, there's different banks, different products. We have a home equity loan that we offer. But what it is actually it becomes a second mortgage. It's a loan against your equity. It's at a fixed rate for a fixed period of time. It can't be reduced because it's just like any other mortgage, it's a loan. Then you can take that money and go out and buy your investment properties. And as you hear me talk about all the time, there's a cool new loan product called a DSCR loan where the lender, in this case me, we don't have to look at your personal income. If the property pencils, meaning the rent will cover the debt, then it's fundable. You can get a loan against it. So it's a super cool product. Take the equity loan, or if for some reason you haven't already refinanced and it makes sense to do it, let's say you're paying off other debt and you want to refinance it all into one and then pull cash out for this, you can get a cash out refinance. Actually, you can do a rec loan with cash out too, or a home equity line or HELOC. Pull the cash out and then use a DSCR loan to buy your investment property. And the cool thing about investment property is, from a borrower standpoint, you're way, way, way less rate sensitive. Now, I'm not saying ignore the rate. I'm not saying negotiate the best rate. Not negotiate the best rate or best loan program available to you. But what I'm saying is, when you're buying an investment property, you're looking at the cash flow. So if the tenant is paying the mortgage anyway, the difference between a 5% or a 6% interest rate, it's really semantics, because you're not paying for it anyway. Absolutely, the lower the monthly payment, the more cash flow you get. But when you're looking at investment properties, there's a broader range when you're trying to make sense of it from a cash flow standpoint, because it's not coming out of your income to service the debt, if that makes sense. You're making sure that the property cash flows to a point that you're comfortable with. And with the DSCR loan, the lender wants to make sure it's a 1-to-1 ratio. They'll actually go down to a 0.75 ratio, which means it can have negative cash flow, but there's other underwriting guidelines that come into effect with that particular program. But if it's a 1-to-1 or better, meaning it pays the bills or it generates positive cash, then it's a fairly painless process to get the DSCR loan. And it's a great loan program for investors of all experience levels. So to summarize, you can do a home equity line of credit, a home equity loan, or some type of cash out refinance strategy on your current property that you mentioned you had a ton of equity in. Take that equity and use that as the down payment necessary to qualify you for one of these DSCR loans. So I hope that answers your question. If it doesn't, give us a shout. 561-291-8569 is the Anytime hotline. And actually, I just want to clarify, by anytime, I mean anytime. It pushes to my office during the week. It rings here in the studio during the show. So not the main number. It rings to the bat line in the office, but it does. We are able to catch you during the week on the Anytime hotline. So hopefully that helps. We're seeing a lot of people capitalize on that DSCR loan. It's a great, great, great loan product for first time and seasoned investors. So if you have questions around that, give us a shout or hit the website, www.mr.mortgage. So one other thing when buying investment property to keep in mind, and we touched on it last week, and I don't remember who the caller was, but they wanted to know what the minimum down payment for investment properties is. And for that particular individual, they were going to move into one of the 4 units. So in that case, a 1-to-4 unit that you're going to occupy one of the units, we can treat it just like a primary residence. So as little as 3% down with a conventional product, or 3.5% with FHA, or 100% with VA, and you're into an income producing product and or income producing property. So this is what I'm talking about when I say read past the headlines to find the opportunity in this market, because even in those high interest rate environments of 1981 that I referenced in the first segment, people were buying and selling real estate, and surprisingly enough, real estate appreciated in 1981. So the cost of money alone should not be a factor. It should be cash flow. It should be budget. It should be your long-term goal. So hopefully that answers some questions. We're going to be right back on the other side of this break. Visit us on the web, www.mr.mortgage. That's www.mr.mortgage, or call us at 561-291-8569. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction, and that starts with a really great agent. If you've got a great agent, that's awesome, but if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. Woo, I didn't know I could sneak to the men's room and back in just 2 minutes, but I did it. So, hey, my name is Mark Eitel. Super excited to be with you. I host the Mr. Mortgage Show. Dom, my producer, and I do this every week right here. Same bat time, same bat channel. So we have reached my favorite segment of the show. We're going to do the rapid round of questions. I know they get kind of stacked up because I like to explain everything in detail. So we're going to try to burn through some questions. If there's something that requires a full explanation, I'll give it to you, but I'm going to try to get through the stack that we have in front of us. So let me throw it over to Don for the rapid round of questions.
I have Susan and Tom who sent in a text. They're asking, we want to refinance and pay off all of our debt. Are there restrictions of what we could pay off?
Hey, great question. And the short answer is no. As long as it meets the loan to value requirements. So whatever we can lump in there, car payment, credit card, student loans, your dental implants, your, Tom, if you've got, bookie bets, or what do you call it? You've got some outstanding money due to the bookie. We can lump it all in there, and you can pay just about everything that you have off, assuming that it meets the loan to value ratios. So questions on that, just give me a shout, and I'll be happy to answer. But quick answer is no. It does not matter what you're paying off. So let's throw it back over to Dom for question number 2.
All right. Terry sent us a message. What are the negatives to a reverse mortgage? I think we're ready. I'm just a little unsure.
Hey, Terry, that's a good question, and I'm not going to rapid you on the answer because that one's important. A reverse mortgage is an amazing, amazing loan product for the right person. And I understand your hesitancy because they're confusing. It's not a normal thing that we grow up understanding. It's something that we address often, only once later in life, and it's new to a lot of people because it only gets addressed one time. So I'm going to answer your question. There are a few things that we get asked a lot. So I'm going to share some very general concerns, and some of this might speak to you. So one of the very big concerns people have is, can I still leave the property to my heirs? I guess the question is, does the bank own my property? You're not selling your house to the bank. What you're doing is you're taking a mortgage, but you're deferring any payments. So you're essentially not making payments, but because of that, the balance grows, but you're not making payments. So it's a loan against your property. So if your property's worth $400,000 and you do a $200,000 reverse mortgage, and at your passing, let's say the mortgage has grown to, I don't know, $250,000, you can leave that property to your children or any heirs, and they can inherit the property just like they would if you had a normal $250,000 mortgage. See what I did there? I used the elevated balance because that's what it had grown to at the time of your death. So that's a big one. Can I leave the property to my children? Yes. What are their obligations on the other end of this? It's the same as any mortgage product. They have to satisfy the lien, and they're either going to take ownership or sell it, and then just get the equity as net proceeds. And that's another question. Can I sell it? So yes, you can take a reverse mortgage today. And let's say 10 years from now, you decide to go into an assisted living facility, or you're going to move in with your kids because you want to be closer to them and they want to care for you. You can sell it. There's no prepayment penalty. There's no commitment to this, just like a normal mortgage product. So again, the balance grows because you don't make payments, but you can sell it at any time. You can freely give it to your heirs. When I say freely, there's still a lien against the property, but there's no restrictions in it going to your heirs, transferring as it would with a normal mortgage product against it. And then, yes, you can sell it at any time, pay off the mortgage, move to the assisted living, relocate somewhere else. So those are common questions. Another one, a big one, is what happens if I owe more than it's worth when I die? And this is a big concern for a lot of people because everybody wants to leave their kids their property with equity in it. It's a goal of all of us. I know, I talk to my mother and that's what she wants to do. We're blessed that our parents want to leave us equity. But here's the thing. If for some reason you outlive the equity in the property, let's say you live 30 more years, and you owe the loan has elevated to a place higher than the value of the property. Or let's say we go through what we did in the early 2000s and property values go down and now the property's worth less than you owe, and you pass and you leave it to your kids, there's no obligation to the heirs. The loan is insured by the federal government. It's a product of FHA. So the loan is paid off by the insurance policy. That's part of the closing costs. Your heirs just give the keys to the bank, and they don't have to sell other assets in your estate to satisfy the deficit because there's no obligation beyond the insurance policy that insures it. So that's a little bit of a ramble. The answer is if you owe more than it's worth when you die, you just give the keys back, and it doesn't encumber any of your other assets in your estate. Those are pretty typical questions that we seem to get the most often. The other one is, how do you access your cash? And you can receive a lump sum payment, you can get monthly payments, or you can receive a initial payment. So you get an initial payment and then an equity line to draw against. So hopefully that answers some of your concerns. And listen, take all the time you need to make this decision. We never, ever, ever rush anybody into a reverse mortgage because it's a big, big decision at a very critical time in your life. But I can tell you this, we're seeing more and more call for it in our lending practice. I'm proud to do them. I believe in the product, but again, they're not right for everybody. But if they're right for you, they can make all the difference in the world. And with the inflation pressures that are on fixed income individuals and all of this newfound equity, it's really a good time to do it, because when your property is evaluated for how much you can get in that reverse mortgage, it's evaluated today at a time that it's never been more valuable. So you've never had more equity to access for the rest, to live out the rest of your life. So hopefully that, sets you at ease, Terry. I encourage you to give me a call. I'll spend all the time you need to walk you through this. 561-291-8569 is the Anytime hotline. And again, that'll push to my office during the week, or visit the website, www.mr.mortgage, and we can address this off the air, because I am happy to answer your questions and walk you through it. So, hey, Dom, what else do we have?
All right. We have an email from Letty. Letty's asking, my agent is telling me I need to put 25% down to buy a condo. Is this true? Are there no other options?
Hey, Letty, there are several other options. So what's happening in the condo world right now is, since the Surfside collapse, the condo questionnaire has been beefed up, because that was evidence of what can happen when the structural maintenance isn't done on a building properly. So there's a big concern that lenders have: are we lending against the next building that's going to collapse? So in that questionnaire, they're speaking to a lot of things that have to do with deferred maintenance. Now, most association members are just civilians that live in the neighborhood, so they're not engineers and they're not comfortable answering questions about structural maintenance, deferred maintenance. A lot of these associations are being coached not to answer the questions. So if the questions aren't asked or are not answered, we have to do what's called a minutes audit. We look at the minutes of the meetings, and we're looking for deferred maintenance to being spoken about in the meetings. If any of that happens, or if the budget doesn't pass review, then you have to go with either a limited review loan program or a non-warrantable condo program, which can require a 25% down payment. So to answer your question, there are other loan programs available with as little as 5% down, but you've got to make sure the association is going to make it through the condo questionnaire process, a full condo questionnaire review, and get the green light. At that point, all programs are available to you. As that becomes diminished, they're not answering the questions or they don't pass the budget review, then you're limited with the loan programs that you can use. And that may be what your agent's referring to. If you have any questions on that, just give us a shout. So here we go into another break. We'll be back in 2 minutes. My name is Mark Eitel. This is Mr. Mortgage Show. 561-291-8569 is how you get a hold of us. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark Eitel and the Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right. I'm back. My name is Mark Eitel, host of the Mr. Mortgage Show, and we are going to keep rolling with your questions. I'm going to throw it over to Dom and see what we've got.
All right, we have Steve who sent us a funny one. He wants to know, do you think the whole Will Smith, Chris Rock thing was staged?
Hey, Steve. I think I know who Steve is, but I don't know. I certainly would have expected if Will Smith was really going to hit Chris Rock, that he would have knocked him over at least. For God's sakes, Will Smith played Muhammad Ali in the movies, but I have no idea. But it was interesting to see all the memes and reaction to that afterwards. So, but yeah, hey Steve, thanks for that question, and you're going to owe me a beer for getting that one on the air. If you're the Steve, I think you are. But anyway, Mark Eitel, the Mr. Mortgage Show, we do this every week, same channel, same time. So certainly appreciate you being here. If you have questions, hit us up at 561-291-8569. Visit the website, www.mr.mortgage, or check out the new Facebook page while you're on the web. Go to the facebook.com and just type in, up in the search bar, the Mr. Mortgage Show. We're building out a new Facebook page for the show, and we're adding a lot of the articles and data sets that you hear me reference during the show there, and you'll be able to read through them in detail, and you can interact with us there also. If you have questions, just drop them in Facebook, and we'll answer them for you too. So hopefully you find that enjoyable. We're going to really keep stacking that full of information, because our goal with this every week is to give you the information that you need to make better real estate and mortgage decisions. Because, hey, there's so much craziness going on right now in the news surrounding real estate. And is this a bubble? Is it going to burst? I hope we set some of that at ease. I mean, you really, really, really need to focus on supply and demand. Yeah, definitely look at interest rates also. They may cool demand, but the real driver in whether this is a bursting bubble is supply and demand. And there are a lot of headwinds in the real estate market, no doubt. But my personal belief, as I explained in the first segment and in that, that rant, if you will, that's on the Facebook page, that I don't believe this is a bursting bubble scenario. I just think we go into a flattening appreciation cycle and allow time to catch us up where we are. So, but yeah, we talked about that. We talked about reverse mortgages. Terry, I hope I put your mind at ease there. Somebody asked a question regarding, what can you use the cash out of a mortgage and debt consolidation to pay for? And you can pay off anything as long as you qualify for the mortgage and it meets the loan to value requirement. You can pay just about anything off. You can pay your bookie off with it. So I'm hoping we answered all your questions. I'm doing a quick mental review of what we had. Different strategies around pulling equity out of your current primary home to buy investment properties. We touched on that. But yeah, hopefully you got your question answered. If you didn't, shoot it to us at 561-291-8569, and we'll get you on the air. But yeah, everybody exhale. Interest rates are still historically low. I know they feel high because of where we came from, but we're still in a wonderful environment. We talked about the DSCR loan for buying investment properties. We even talked about buying an investment property as a primary residence with as little as 3% down, which I think is an amazing opportunity, because if you're going to jump into the real estate market and you're going to capitalize on positive cash flow as well as appreciation, how awesome would it be to have 3 other people helping you pay your bills in the form of, in a 4-unit property if you live in one and rent the other 3 out. Now, that's assuming you want to be that close to the other 3 people. So you better rent them out to people you like, but just a great, great opportunity. We talk about it all the time. Look past the headlines, look to the opportunity, because it's out there. And our goal, as always, is to get you the information you need to kind of navigate through these waters. So we certainly appreciate all your questions, and hopefully we address them. We are going to continue to answer anything you have at 561-291-8569. But we are wrapping this one up. So we will be with you again next week, same bat time, same bat channel. And during the week, I encourage you to hit the Facebook page. The Facebook page is The Mr. Mortgage Show. There you'll be able to interact with us, get your questions answered, and find a lot of useful data that we use to put the show together each week. So again, my name is Mark Eitel. This is The Mr. Mortgage Show. You can find us online at www.mr.mortgage. That's mr.mortgage, no.com.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.